In this video, I want to talk about 12 real estate myths that may surprise you. I'm Chris LaChava with RE/MAX Heritage Professional, your real estate advisor, and I want to talk with you about these 12 real estate myths that might surprise you. The first one is the myth that you need a 20% down payment. This is, despite a lot of information to the contrary, there's still a lot of people that believe you need 20% down, and that is keeping them on the sidelines from purchasing a home. You know, the average home price in Winter Haven, Polk County is around $300,000. And so if you need 20% of that, you're talking a good chunk of money that most people just can't come up with. And so, you know, $60,000 is a lot of money, and most people can't come up with that. And so the reality is there are all kinds of different loan programs out there, and there's a conventional 3% down, 5% down, 10% down. FHA is 3.5% down. I actually think there are some lenders that have a 0% down FHA as well. There are VA loans, which is 0% down, and USDA loans, which are 0% down. So there are lots of options out there that don't involve 20% down. And so I really want you to forget about the myth of 20% down. Very rarely do people put 20% down. Certainly they don't for their first home. I don't know very many people that put 20% down for their first home. Really a majority of people actually use the FHA loan, and so they're looking at 3.5% down. That's pretty common. The second thing that a lot of people believe is that online home value estimates and agent pricing are equally accurate. And I talk with my potential clients all the time about this. So Zillow had a program, has theirs estimates. You can all go on Zillow and you can see theirs estimate. And they had a part of their business that bought and sold homes based on the Zestimate price. You know what happened to that part of the business? It went out of business because it's not accurate. Here's the thing about online evaluations. No one's been in your home. All those online evaluations do is look at your home and see that it's a 3-bedroom, 2-bath, built in 1980, and they compare it to other 3-bed, 2-bath homes built around 1980. 1,500 square feet, they look for similar square footage. What those online valuations don't take into account is what you've done to the home and what condition your home's in. So what does that mean realistically? Let's say that you went ahead and you refurbished your entire kitchen. You did a major kitchen remodel. Let's say you upgraded all your bathrooms so they're all modern. Let's say you put in all new flooring. You've got a new roof. You've got a new hot water heater. You put in all new appliances when you did your kitchen renovation. You have painted the interior and exterior. I'm just giving some examples. Let's say you've updated all the windows to hurricane impact windows. And let's say the home down the street is, they haven't done anything to it since 1980. The cabinets still look the same. They have that puke green refrigerator or appliances. They have linoleum flooring and carpets. The roof is got patches on it, but has never been replaced. Guess what those online evaluators do? They say your home is worth the same, when in reality, they are not. The only way someone can differentiate between your home that is fully updated and modern, built in 1980, and a home built in 1980 that's original, is to have someone come in and see the updates and see the condition, and then take that into account when evaluating the home and giving you a value for the home. Any other way cannot take that into account as accurately as someone who comes and sees the finishes, sees the work done. And so online home value estimates and that of an agent who comes in person are not equal. Myth number 3, home renovations always increase home value. So first of all, the one thing you should know is it's not a dollar for dollar replacement. You can't say I put $40,000 into this kitchen, so therefore my $300,000 home is worth $340,000. It doesn't work that way. Comps still matter, and you got to look at renovations partially as you're doing them for yourself. You are not going to get the full value out of those. The other risk that you run is over improving. So if, let's say, you and your neighbor have $300,000 homes and you decide to do the top end kitchen and you spend 50, 60 grand on that kitchen, you're not going to get $350,000, $360,000 out of that home. You've over improved it. Buyers aren't going to pay that, because what they'll say is, I can buy the cheaper home for $300,000. I can do a $20,000 or a $30,000 kitchen upgrade without going high end on everything, and then I've got the same home for $330,000. I saved myself $30,000, even though I had to do the work. Oftentimes, smaller renovations or home projects increase value more. Actually, things like replacing a front door or painting the interior exterior home actually will have a bigger return on investment than completely renovating your kitchen. You also run the risk when you do a renovation that you might not renovate it in a way that others like, because you're still going to have your taste involved, and your taste may be different than others out there. Myth number 4, renting is smarter than buying. It might be true for some people. If you are not planning to stay somewhere very long, at least 5 years, then it probably makes sense to continue to rent. But if you're planning to stay somewhere from 5 to 10 years or maybe longer, then usually buying is going to make more sense for you. Now, it all depends on your financial situation, your job situation, and things like that. But in general, if you're going to stay somewhere very long, it makes more sense to buy than rent. But if you're not going to stay very long, renting is the way to go. And I know that's shocking. The realtor just told you that. Myth number 5, the mortgage lender offering the lowest interest rate is the best. That's not always true. We always say this, sometimes you get what you pay for. And the reality is there's so many other costs involved in a loan. Really what you want to look at is the annual percentage rate, or APR. That provides a clearer measure of the loan's total cost, because that includes closing costs, loan origination fees, and discount points. And those are important parts of mortgage shopping. So the rate may be better, but you may be paying more for that rate. For example, they may be charging you more discount points, and so you may save more money over time going with a slightly higher rate if the APR is better. Myth number 6, you need perfect credit for a mortgage. This simply isn't true. Usually a score in the mid-70s or higher gets the best rates, but oftentimes lenders will go down to 620 and even 580 for some types of loans. So you do not need perfect credit in order to qualify. You will get better rates the better your credit score is, and that's important to keep in mind. Myth number 7, student loan debt nixes qualifying for a mortgage. This isn't true. It does factor in, however. So it depends on, it gets calculated into your debt calculation. So your debt to income ratio, it affects that. And so they're going to factor in that monthly payment, however much that is, against your debt to income ratio. And so it could disqualify some people, but it is not automatic. Depends on how high your monthly student loan payment is. Myth number 8, bidding wars have ended. While we are not seeing the widespread bidding wars that we saw during the pandemic, there are still homes in certain communities that do have bidding wars. If the home is updated nicely in a very sought after community and it's priced well, you could still end up with a bidding war on that particular home. So they're not completely gone, they're just not as common. Myth number 9, new home construction costs much more than existing homes. The reality is that out-of-pocket expense, they may be cheaper right now, because builders are dropping the price of the home because they can afford to, because their job is to get rid of inventory so they can build the next home. But not only are they dropping prices, they're paying all your closing costs as a buyer. They're often buying your rate down to 5%, which is much better than the prevailing 6.78, I think I saw the other day. And so when you factor in the fact that you can get that home for less out of pocket, plus your homeowner's insurance in general is going to be cheaper because it's built to the latest code. Your home repair costs are going to be lower because, again, it's a newer home, so presumably all of your systems are new and should last a while before you would need to start putting money into repair and replacement. So actually, new homes are a really good deal right now. And so that's something to keep in mind. Myth number 10, housing affordability is a problem on the coasts. It can be anywhere. It's not just to the coasts. The middle of the country has some home affordability issues. It really varies, and really it just requires you to be realistic. Don't overpay for a house. Don't buy at the top of your budget. If you do those things, you'll be okay as far as the affordability goes. And you remember, your first home is not your forever home. So we all have a list in our head of what our perfect home looks like. For most people, that's not going to be your first home. Your first home is a stepping stone to get to that perfect home. Myth number 11, pre-approval and pre-qualification are the same. I'll explain it this way. A pre-qualification is you go to a lender and you say, I make $100,000 a year, my credit score is 820, and I have no debt. And the lender says, okay, here's your pre-approval for a $600,000 or $700,000 home, we're good to go. Go shop. Well, the lender hasn't looked at any of the documentation, and believe it or not, people do lie or just aren't really sure of what their financial picture looks like. A pre-approval says, okay, I'm going to pull your credit, I'm going to look at your bank statements, I'm going to look at your income, I'm going to look at your taxes, and after I've seen all of that documented, I'm going to offer a pre-approval. You want to be pre-approved. That gives you a more accurate idea of what your actual budget is. Your realtor can be more helpful knowing you have the pre-approval, and honestly, sellers are not accepting pre-qualifications. They want you pre-approved to go under contract. Finally, myth number 12, we're headed for a 2008 housing crash repeat. It's important to understand that back then, housing prices plunged 30 to 40%. And it occurred because of risky subprime mortgages that appeared heavily on the market. So around 30% of transactions were distressed properties or those in foreclosure or short sales. There are much better underwriting processes in place, standards are in place. Distressed property activity, even in Florida where we lead the country in foreclosures, is only at 2 or 3% compared to 30 to 40%. Most homeowners have equity. A lot of them have a lot of equity. So the reality is the market is nothing like that. We are not seeing price drops of 30 to 40%. If we see 5% 1 month over last year, that's significant, but that's the most we've seen. We are not headed for a housing crash. We are in a housing correction. If you saw my video on the market update, I talk quite a bit about the difference between a correction and a crash. Anyway, I have busted those 12 myths for you. I hope you found this information helpful. If you or anyone you know is looking to buy or sell a home in Central Florida, please reach out. I'd love to help. Remember, you can't mess with Chris. Have a great day, everybody.